Is my screen visible from your end? Okay, perfect. So we'll start with the normal drill. We'll start from the assignment. So I'll jump straight to the assignment. So this was the assignment that was supposed to be done. So we'll start. So the first question was, which type of order blocks do we expect from a resistance level? Anyone? Anyone to help us tackle that first question? Which type of order block do you expect from a resistance level? And well at it, when you're answering it, please give us a reason as to why. Let's go. Ian?
A bearish order block.
A bearish order block. Why?
Because the resistance it is at the top, so it will happen because there will be an indecision of the market when it is red. So like kutakuwa na bearish candlesticks when they're going down, and then there will be like a green candle that will be your order block.
Yes, you have actually described it very well, but the best way would have been, let me just refresh you guys again. So we have our resistance level maybe at this point, resistance, then we have our support level down here. So just to remind you guys that at the resistance level, the way we described the resistance level, we say that at the resistance level is the level as to which you expect to experience a selling pressure. That is what we describe the resistance level. So we describe a resistance level in two ways: a level as to which you expect an uptrend to come to an end, an uptrend right here to come to an end, and a zone to which you expect to experience a selling pressure. So what type of order block would you expect from a resistance level? Yes, it is a bearish order block, and this is the reason. So from this leg up here, remember this is a bullish stretch. So from this leg right here, we are having a green candle. So we are having the last green candle before this significant sell right here, before that significant sell. And we said the last green candle before a significant sell, then that is what we call a bearish, let me name it, a bearish order block. So describing on the same, then from a support level, remember this is the support level. From the support level, then we describe that the support level is the zone as to which we expect a downtrend, this downtrend right here, to come to an end, or a zone as to which you expect to experience a buying pressure. So the type of order block that we'll get from this zone is, remember this is a downtrend, so downtrend is represented by red. So we're going to have the last red right here, last red like that, the last red before this significant buy right here, before this small significant buy. Let me just highlight it, before this the last red before that significant buy right here. And we described a bullish order block as the last red before a significant buy is what we call a bullish order block. Let me name it a bullish order block like that. So basically what we have tackled question number 1, which type of order blocks do you expect from a resistance level, and which type of order block do you expect from a support level. Then you're supposed to explain on that, which we have done. Then the next question was, open the BTC USDT chart on the 4-hour time frame and identify a bullish order block and a bearish order block. So this was simple. Just go to the chart BTC USDT, identify a bullish order block, that is the last red before significant sell, and also the last green before significant buy. That is what is now what we call a bearish order block. Then the last question was, open the ETH USDT on the 4-hour time frame. I bet everyone can do that first part. Then identify a bullish breaker block and a bearish order block. Let me navigate to maybe one example that I picked from the submission some of you did. A bullish breaker block and a bearish order block. Let me just do this. So this was well put. If you can see right here, this was the last red, the last green, sorry, before significant sale. So this qualified being a bearish order block. But what happened is, so what we expect is that the market will come, respect the bearish order block and have a significant sale. But what happened is the market disrespected that zone. So it ceases from being a bearish order block, and now it becomes a bullish breaker block. And also from this zone right here, we can see there's a bearish breaker block. So we have the last red right here, I highlighted using this rectangle. We have the last red before this significant buy. So it qualified being a bullish order block. So expect the market to come into this zone, then buy. But what happened is that the market disrespected that bullish order block, and now it ceases from being a bullish order block, and now it becomes a bearish breaker block. So that was basically what was expected from the assignment, and that was now POIs. What we did yesterday was a type of POI, which is the order block and the breaker blocks. Just to jump into what, before I jump to what we're supposed to cover tonight, any questions on the assignment or any question on order blocks and breaker blocks? Any question? Order blocks and breaker blocks, any questions? If everything is clear, guys, kindly confirm for me so that I can move on to the next POI that we're supposed to cover tonight. A thumbs up or any reaction. If everything is clear, please kindly confirm for me. Okay, perfect. So we'll jump to the next POIs, and the POIs that we're going to cover tonight are the fair value gaps, or what we call the liquidity void or the imbalance. Then you're going to look at what we call the stop hunt. Then the last thing you're going to cover is what we call the Quasimodo level. So let's start with the fair value gap. So before even I cover the fair value gap, I remember yesterday, if I'm to navigate to that image, let me see if I have it. It was an exact image of this. And I remember saying that every time a market leaves an imbalance, the market must come back to fill those imbalances. So basically, this imbalance now from the last class picture, it indicates an imbalance. The correct term to call this imbalance is what now we are going to cover as the fair value gap. So what brings about the fair value gap? We said that if we have a stretch where we have either buyers that exist in the market alone without the presence of the other, then we're going to have an imbalance. So an example is, in this stretch right here, we had a period where only buyers were existing in the market with zero or next to nil sellers in the market. So what will happen is the sellers must come down to fill this imbalance before now going up again. That is just the technical description of it. But the theoretical way of describing these imbalances is assuming people who bought this project at this down here, then the market went up. Remember, you had buyers buying at this point, then the market went up. What do you expect if you're now in profit? We expect that people are now going to collect their profits, and the process of collecting their process is now selling. So this sell off is now what you are saying is the mitigation, the process of the market coming to fill the imbalances. So in technical terms, we're gonna say the market is mitigating, but theoretically, basically what the market is doing, the buyers who are now in profits are collecting their profits. So they are selling off that project so that they collect the profits. And in so doing, now the market comes down. And that is what now in technical terms we call as mitigation. So basically, this is what you call an FVG. So what is an FVG now? This is insufficient trading in the market. Insufficient trading in the market. So what do I mean by sufficient? Remember, the market is made up of sellers and buyers. So the sellers must equal the buyers. So if this is not met, now the insufficient trading in the market is now what occurs. So it happens when the market moves aggressively in one direction, creating a gap or an imbalance. So when there's insufficient trading in the market, price often comes back to fill that gap. When there's insufficient trading in the market, like at this point right here, the price will always come back to fill that gap. This is because there were less buy orders being compared with the sell orders and vice versa. So price coming back to fill that gap is what we call mitigation. However, mitigation is not a must to occur because of various other factors such as fundamentals. And I'll give an example. Let's say today we have fundamental news on BTC. We can have an example like maybe the BTC halving. So if you have the fundamentals on BTC halving, definitely the market will buy because now people are believing in BTC. So the market will buy. The moment the market buys, let me just navigate to this diagram. Assuming this was BTC, now we have found fundamental analysis here of the BTC halving, and it bought to these levels. Before even BTC could come down to mitigate this market, then we have other positive fundamental news on BTC. Let's say the CPA data comes as bearish. CPI, sorry. The CPI data comes out as bearish for USD, like what we saw the day before on Wednesday. On Wednesday we had CPI, and now it was bearish on USD by -3%. That means now it's bullish for BTC. Always know that when the CPI is negative on USD, it is now bullish for BTC. And when it is bullish on USD, then it is bearish for BTC. So what I was explaining is we are now having positive fundamentals, two positive fundamentals following each other on the same project. That means now us having an expectation of that the market is going to come and mitigate here after the halving fundamentals is a fallacy, because now we are having now other fundamental news that are positive for BTC, so the market will go up. And no wonder we are saying that mitigation is not a must, because it will depend on other factors such as fundamentals. And you should always know that in crypto, fundamental news are more stronger than the technical analysis. For example, today the market will show you that Doge is bearish. You've done all your technicals, you're good at it, and the market shows you that the Doge is gonna go down. But today, on the same day, Elon tweets something on Doge. I promise you that the market will not respect your technicals, but rather it will follow the fundamentals. So no wonder you're saying in crypto, fundamental news actually so powerful than the technical news. Anyway, so how do I get to identify these FVGs in the market? So you're saying FVG is a 3 candlestick pattern where there has been a move in one direction that leaves a gap or inefficiency visible on the chart before 1 and 3. So what do I mean by this? So I'll just navigate straight to this image right here. Let me, like that. So what do I mean by, how do we get to identify VGs in the market? If you look at this diagram right here, we are having 3 bullish candles following each other. So if you come to the market and the lowest price, let me start by this one, the highest price, remember I said the highest price is always represented by the top wick. So if the highest price of the first candle right here, the highest price of the first candle, in between the highest price of the first candle and the lowest price of the third candle, there's a gap there in between, then that qualifies being called an FVG, or a void, or a liquidity void, or what we call an imbalance. So the same, it's also the same for a bearish FVG. So if the lowest price of the first candle, if in between the lowest price of the first candle and the highest price of the third candle, there's a space there in between, then it qualifies being called an FVG or an imbalance. So I'll just show you in the charts right here. Let's navigate to maybe a chart right here, for example. So we are having 3 candles. This is an example of a bearish one. We are having 3 candles following each other like this. We are having this, the bottom part of this first candle, or the lowest price of the first candle, and the topmost price, the highest price of the third candle. So if they're in between, have a space, then that qualifies being called an FVG. Let me show you like that. And this is how we name it, or rather we illustrate it. So from that price right there, in between the lowest price of the first candle and the highest price of the third candle, if there's a space there in between, now that is what you call an FVG, like that. If I move down here, you have a really big one. So the bottommost price, or the lowest price of the first candle, and the highest price of the third candle, just right here, they're in between. Let me draw. They're in between now. That is also an FVG. Let me go in the case of a bullish one. We're having these 3 candles following each other. So the highest price of the first candle right here and the lowest price of this third candle right here, we have an FVG right there. So I'll do another one. So let's navigate to our charts and see if we're gonna see another one. So let me see. Perfect. We have this other one right here. The highest price of this first candle right here, the highest price of this first candle, and the lowest price, this didn't have a wick, but now the closing price of it, the opening price of it, if there's a space right there, that's an FVG right there. And also when it comes to this downtrend here, I've also identified one right here. So the lowest price of this first candle right here and the topmost price, or the highest price of this that candle here, we are having what we call an FVG right there in between. Let me have it in maybe white. Right there, we are having what we call an FVG there in between. So that's how you get to identify, or rather illustrate, FVGs in the market. So basically, that is how we identify FVGs, and FVGs we call them now also, we have called them also the liquidity void or the imbalance. So how do we get to trade the FVG? Before I move to how we can trade an FVG, is the illustration on FVG understood? If you can now identify an FVG on your charts, please send a thumbs up on the chart. If you can comfortably identify an FVG. Okay, perfect. So we'll move to how to trade an FVG. On most occasions, the price tends to come inside the FVG. Just like the order blocks and the breaker blocks, the FVG also acts as a magnet to the market. So it will pull the market to come and mitigate it. Remember, you said the process of the price coming back to fill these liquidity voids, or the FVGs, or the imbalances, is what we call mitigation. So mitigation is basically the FVG acts as a magnet to the price. So the market tends to come inside those FVG before making an impulsive move. And we have an example right here from yesterday. We're having a zone as to which we had imbalances, and if you look at this clearly, the highest price of this candle is right here from the wick, the highest price of this first candle, and the lowest price of this third candle. There in between, there's liquidity in the market. And no wonder I was saying yesterday, you don't only use one POI to confirm a trade, because if you look at this chart now, having understood what FVGs are and order blocks, you'll notice that the market, not only was it coming back for the bullish order block, but also we had the other confluence as the FVG, so the mitigation. So we had two confluences, bullish order block and the mitigation. And what caused the mitigation? The volume, the liquidity void, or what you call the FVG right here. No wonder we said every time before you confirm a trade, always have more than, the more the merrier, more than one confluence, then you can take that trade. So basically, we are saying that in most occasions the market tends to come that FVG. So what can you take from this? One can always have an entry, just like the order blocks and the breaker blocks. Remember I said they can act as POI, and POI means point of interest, and that means they can be used as entry or exits to a trade. So I'll give an example. Let's see if we're going to identify one. So from just what we have drawn from this chart right here, let's see if our FVGs were made. Exactly. If you look at this FVG right here, we have two things. Not two things. We have the market actually respecting our FVG. And the point that you're saying, it can be used as take profits and entry points is by this. So if you came to the market when you're at this point, let me see. If you came to the market when you're at this point right here, you'll notice that the market has left an FVG right here at the bottom. This one, right here at the bottom here. You'll notice it has left an FVG. And you have said the way to trade an FVG is to know that the market will come to fill that imbalance. So what you'll do, you'll have your entry from this point right here. You're going to have so you have identified your FVG. So you're going to have your entry at this point. Let me draw. Let me have a long position tool. Like that. You have your entry at that point. So as the market is coming down to fill that liquidity void, as the market is, let me use the correct term, as the market is mitigating, rather coming to fill this imbalance. You remember, you can trade 50% of it, just the same as the order blocks and the breaker blocks. You can decide to have your entries either the tip right there, 50% of it at this point right here, or at the bottom of it. So like I said, me to be safe, I always use the 50%. So if you're having your 50% like I do, you'll have your entry around that point, assuming that is 50%. Along that point, have your stop loss like that. Then when you're taking your when you're taking your take profit, always come to the left of your chart. And if we come to the left of our chart, we notice we also have an FVG at the top right here. All these zones, we have FVGs. So you can decide to have your first take profit from that zone right there. That's an FVG. We also have this other FVG right here. And if you notice, the market actually filled all of these. So the market, let me just try and zoom out so it can be visible. Like that. So you'll notice the market actually respected that FVG. So it will come down, trigger you into that entry, then buy. So your first take profit can be at this zone right here, this zone. So from this zone right here, if I'm to extend this tool, you'll notice you'll take profits from this zone. This zone, this will be your TP1. Let me just name it. This will be take profit one, like that. So, and if you are patient enough and you want the market, you're waiting for the market to come and fill this other, actually it's this one, because this one was already filled. Let me just return it like that. This one was already filled, so it's this one right here, this red one. So if you're patient enough to wait for the market to come and fill that one now, then we are having you'll wait for longer, but at the end of it all, the market will come and tip. You see, from this zone here, this sharp wick actually mitigated that POI at that point right there. So no wonder I'm saying order block FVGs are really powerful POIs. So you'll notice that now the market came back. It will take some time, but at the end of it all, you're gonna be triggered as you take profit at this zone right here. So FVGs are really quite powerful. If I move to this part, you'll notice every FVG that I spot was actually mitigated. Let's see this one. It was actually mitigated. The highest price of this first candle and the lowest price of this third candle. You'll notice the market came down and mitigated that. Also, at the bottom here, you'll notice there's another one. This one right here. The highest price of this and the bottom price of this, you'll notice if I extend it like this, it was mitigated at this zone. If I continue like that, you'll notice almost all of them. So also we have an FVG. Let's see if this was mitigated from this point to this point. It was mitigated at this zone right here. So FVGs are really powerful and they can be used as POIs to a trade. Let's see if we have left anything else. So yes, that's it. So just to give you examples of FVGs in an uptrend. So you'll notice from this point right here, we're having an FVG right here from the highest price of this first candle and the lowest price of this third candle. So they are in between, we are having an FVG, and the market actually respected that FVG before buying. That's the case of an FVG in an uptrend. And in the downtrend, we also have the same. So we are having the space, or rather the gap in between the lowest price of this first candle and the highest price of this third candle. This was mapped out incorrectly. Actually, the rectangle should be at the bottom here of this third candle. If you extend that, you notice it was triggered twice. This came back to trigger the FVG, and this part right here also came back to retest the FVG. So basically, this was a really powerful FVG. Any questions on FVG? Yeah.
When an order block is triggered twice, does it necessarily mean that the dip is going to be copious?
If
the order block is
a
triggered
bearish one
twice,
or a bullish?
Okay, a bearish one. It is, for instance, a bearish one. If it is triggered twice, does it necessarily mean that it is going to be a copious one?
Yes, it means that that bearish order block was really a strong one, and we're going to experience a dip. So that is what, if even not even order blocks alone, if FVGs and any POI that is retested twice, it means now, I think I can, let me share my screen on this other side. I can show you a trade on I took on BNB. Let me share that. Share now. Let me see if the screen is visible from this end. No. Let me stop sharing and share again. Let me stop sharing from this. Okay. Is my screen visible? Kindly confirm for me. Perfect. So if I'm to share a trade ahead, let me navigate to this. It was on BNB. So yes, perfect. So if let me refresh this. If you look at this point right here, we haven't covered on stop hands, but this was a stop hand region that let me just navigate down, but we're gonna do that right now. The Quasimodo, this was a Quasimodo level. I think I identified it on the 5 minutes time frame. Let me see. Perfect. Also remember, you can't win all trades. If you look at this, I was stopped out of this, so this was a losing streak. But anyway, if your risk reward ratio is good, then you'll notice that from this trade right here, I only lost $10. If you can look at this position tool right here at the top here, I only lost $10. So yeah, but this is what I was saying. This was a Quasimodo level. This is also a type of a POI. This was a Quasimodo level from this point, and as you can see that it was retested twice. Retested first on this zone. I wasn't triggered because I always take 50%. Then it retested the second time on this point right here. Then it retested the third time. If I'm to extend this, it retested the third time. And you're saying if your POI is tested more than one time, then it means it is a very, very, very powerful POI. So because this was a very powerful POI, and remember this is a bullish order block. So what did you experience after that? Immediately after being tested 3 times, like the sellers were trying to break through this level. They tried, still didn't have the volumes, then retried again, still didn't have the volume. So after retesting it 3 times, we had a significant buy all the way to my take profit right here. And also there's someone who maybe had their take profits maybe higher than mine. So even if they took their take profits from this zone right here, let me just delete this and try to extend this one. If they took their take profits from all the way here, then they still made money because we had a significant buy following that retesting. You can see we had all these significant buy all the way to that zone. So basically, if your POIs are retested, either it's order blocks, breaker blocks, FVGs, retested more than 2 times, note that now that is a really, really strong POI. Have I answered your question now, Ian?
Yes.
Okay, thank you. Let me now go back again. So if I'm to come back here, okay, perfect. So if no questions on POIs, then we'll move to the second part of what we call this one, FVG. So the second part we are going to look at is now the stop hunt. So what is a stop hunt? A stop hunt refers to an event in time when a lot of traders stop loss orders, or rather your stop loss is hit. It doesn't matter if the trader is holding a long or a short position. Stop hunt means when majority of stop losses orders are executed. Then what do we use now to confirm that this was a stop loss? If as soon as you're stopped out of that trade, the market goes your way. For example, in this diagram right here, this diagram right here, you can see that this trader's prediction was the market is gonna buy. But what the market did, it came, stopped them out. This is a stop loss zone. Remember, we have in our entry here, take profits here, and our stop loss right here. So if the market comes and stops you out of that trade, then immediately after stopping you out, it goes in the direction that you had predicted. Then that is what is a stop hunt. It is very, very painful because you have been stopped out, then the market goes all the way to your take profit. So that is what we call stop hunts. So how do they happen? They happen when you have opened a trade after scanning the chart. Imagine you have scanned the chart, seen a good trading opportunity, you have defined your stop loss, your TP targets, just like this guy. You have identified your stop loss, your TP targets. Then you are confidently waiting for the price to move in your direction, because basically you've done everything you could to justify. You've looked for confluences, you've looked at that coin's fundamentals, everything that you think you could do to justify the trade. Then the market goes to your stop loss, knocks you out of that position before proceeding to move in your original direction. So no wonder we're saying it is very, very painful. So these are examples of stop hunts. So you'll notice that this B zone area could be someone's stop loss right here. But what the market, this person had done their analysis, since this market is gonna sell, so they had their stop losses. Remember, the market makers know that most traders place their stop losses just below or on their previous swing highs. So this was the previous. Ignore this part right here. Remember, this market was not formed when this trader was coming in. So they had their stop loss just above this swing high, and the market makers know that. So what they do, they'll take the market up to collect your stop loss. Remember, stop losses are ni pesa una lose. So this is money. This money sitting around this zone. So imagine how many traders are having their stop losses at this zone. So they're coming after your money. So they'll stop you out, and immediately after you've been stopped out, the market goes in your direction. Very, very painful. Also for A, they had their stop losses here, but the market comes down, stops them out before going into their initial direction. The same thing happens on this C person, on this zone right here. So the market comes, stops them out before going into their initial direction. So it is very, very painful. And how do they occur? So stop hunts occurs when traders or large market players intentionally, no wonder I said the market makers intentionally drive the price of an asset to a level where these stop losses are clustered. So by triggering those stop loss orders, they create a sudden down movement in price, causing a stop loss orders to execute potentially. So this is what these statements means. So the market makers, or rather these big market traders, they know that most traders have their stop losses on the previous swing high. So they'll come and notice this is the previous swing high, and they know a lot of money is sitting there. A lot of money is sitting in those zones in form of stop losses. So they'll drive the market up. They are collecting your money, then it goes in your direction. So how do we get to avoid these stop losses? So this brings about what now we call how can we now avoid this stop hunt whatever. So this now will bring us to something we call the Quasimodo level, or the Quasimodo pattern. So just to finish up on this note, so stop hunts usually is because of identifying a POI that is weak. So to avoid a stop hunt, always look for confluence. And remember, I said confluence is more than one POI that are aligning with your strategy before taking that trade. So another way to avoid stop hunt is now the Quasimodo pattern. So what do we mean by the Quasimodo pattern? Quasimodo pattern is a combination of the stop hunt and the market structure shift, aka the change of character. So let me just describe to you how maybe a bearish Quasimodo pattern is formed. Let me just navigate here. So we are having something like this happening. Okay, let's use this free space right here. So you're having something like this happening. Who can tell us which type of market structure is this that I'm drawing? This one right here. Which type of market structure is this that I've highlighted in green? Anyway, this is very simple. Type of market structure, is it an uptrend, downtrend, accumulating? Cyrus?
Uptrend.
An uptrend. Also on the same Cyrus, can you help us draw break of structures and the change of character? So this is
let me give it a try.
Okay.
At the peak of the first uptrend.
Right here. Or right here?
No, there.
This is what we call now?
Break of structure.
Yes, break of structure. Okay, so the next one will be at this zone right here, correct?
Yes.
Yes. I need you to tell us where the market structure shift is coming to form. Let me just name it. Where's the market structure shift or the change of character?
I would say the bottom.
Right here or right here?
Yeah, right where you are first.
Right here?
No? Yes, there.
So this is now a change of character. Yes. Let's
Change
appreciate Cyrus. Let's appreciate Cyrus. Guys, that was well done. Perfect. So this is what we call the break of structure. This is an uptrend, first of all. Then you're having break of structures on these levels. Then we have a change of character. So we are saying remember what you're saying, that a Quasimodo pattern. What does a Quasimodo pattern encompass? It encompasses, it's a combination of a stop hunt and a change of character. Remember what we said about the stop hunt is when the market stops you out of a trade. So, and a change of character. And also, just to give you a glimpse of how a Quasimodo pattern looks like, it was derived from a cartoon which has shoulders that were not the same level. So one was slightly higher than the other. So let's go to the chart and see how that cartoon thing relates to Quasimodo. So if you come to this part right here, remember we said stop loss orders are always on top of the last swing high. So if we didn't have this part right here, let me draw like that. If we didn't have this part right here, this will act as our last swing high. This point right here, this, let me use a highlighter to do it. This last part, this one, will now be our last swing high. So many stop losses will be sitting at this zone. Remember, there are different types of traders. We have the SNR traders, the support and resistance, for example. And the support and resistance traders believe that this is their support, their resistance zones, that the market cannot break through this zone. So what they will have is their stop losses at this zone. Even the indicators traders will have their stop losses at this zone. So you can imagine how much money is sitting around this zone. So a lot of stop losses are here on this zone right here. A lot of stop losses. Let me just name that. Stop losses are sitting on this zone because it's the last swing high. But what the market does, it comes back to stop them out before continuing with the trend, this downward. So in short, this last part right here, it can cease to now, it can stop from being a break of structure, and now we can call it a stop hunt zone. A stop hunt, like that. So now it's a stop hunt. Let me delete this. It's a stop hunt like that. So, and you're saying that a Quasimodo pattern is a combination of a stop hunt and a change of character. So this zone right here now, this zone right here is now what we call a Quasimodo. And if you look at it, yes, this looks like two shoulders, this first shoulder and this second shoulder right here. So now representing that cartoon with two unequal shoulders, so like that. So this is now what we call the Quasimodo pattern. The Quasimodo pattern, let me name it Quasimodo pattern, like that. Now that is the Quasimodo pattern because it is a combination of a stop hunt zone and a change of character zone, like that. So how do we get now to identify POIs on this? Or rather, how can we trade this type of Quasimodo pattern? So let's come to this part right here. You see they've jumped something. So this is basically what I was describing. It's a combination of a stop hunt zone and a change of character. If I'm to draw a straight line right here, you can notice that this now is a change of character. So the one that I've drawn right here is a bearish Quasimodo pattern. Let me see if there's something I've done. Okay. So in this case, let's just come back here. So how do we get to trade this Quasimodo pattern? There are two ways you can trade a Quasimodo pattern. The first way is trade the breaker block, and the second way, trade the Quasimodo level. Remember, I highlighted all this as a Quasimodo pattern, not a Quasimodo level, a Quasimodo pattern. So the two ways you can trade this Quasimodo pattern is number one, trade the breaker block. The breaker blocks, then or trade the number two, trade the Quasimodo, the QML, the Quasimodo level. So let's start with the first way, the breaker block. So what do I mean by this? So I remember we had mentioned this. This is the last leg before significant, the last sell before significant buy. So this basically is the last red right here. The last red before significant buy. What did we call it, anyone? The last red before significant buy. Last red before significant buy. last thread right here, and also last thread right here. Last thread before significant buy. Anyone? The last thread before significant buy. Is it a okay, Ian?
Bullish order block.
Yes. So all of these are bullish order blocks. So we have a bullish order block from this zone, a bullish order block from this zone, and also a bullish order block from this zone. So what we expected from this zone is that the market is gonna come, respect this bullish order block. Let me have it like that. Respect this bullish order block. I should have done this. Let's kwanza highlight it. So we are having our bullish order block from this zone like that. So what you expect the market to do is that the market will come, let me have this, the market will come, respect this bullish order block, then buy. But what happened is the market actually disrespected this bullish order block, so, and broke through the bullish order block. After a bullish order block has been disrespected, what does it become? Ian, because you have told us this is a bullish order block. When a bullish order block is disrespected, it ceases from being a bullish order block to a
bearish break of structure.
eh?
A bearish break of structure.
A bearish, you are correct, but a bearish breaker block. So it's yes. So it ceases from, remember it was a bullish, it was initially a bullish order block, but it has been disrespected, so it becomes a bearish breaker block like that. And no wonder we are saying if you want to trade a Quasimodo pattern, you can trade it number one as a bullish breaker block, trade the breaker blocks, or trade the QML. So the first one is the breaker block. So we have the breaker block. The market has basically broken through, and you're having a change of character. So we know that the market is changing from now becoming from an uptrend now to a downtrend. So the first way of trading this Quasimodo pattern is actually trading this breaker block right here. In this case, you're having now this is a bearish Quasimodo. So the first way you can trade is have your entry point from this bearish breaker block, which was initially a bullish order block. So the market to come to a zone before continuing with the downtrend like that. The second way you can trade the QML is actually the best way to trade the QML. The zone of the QML, now the Quasimodo level. So how do we get the Quasimodo level? So the prices between, or rather on this leg, any price above the change of character going up here, that is what we call a Quasimodo level. So look for POIs on this leg right here. If we identify an order block from that zone, well and good. If we identify an FVG, if we identify all those POIs that we have covered, we will also cover power of a wick. If there's a strong wick from this zone, then that is where the optimal sell will come from. So you'll notice in most cases what the market will do, it will have the first one to induce to respect the breaker blocks, in this case the bearish breaker block, before having a sell. But the optimal sell will come from the QML zone. So the market will still come, this will act as inducement. So the market will still come into the zone of the QML and have now the optimal sell from that zone. So that the second way is actually the best way to trade a Quasimodo pattern, from this zone all the way to that zone, and having a sell on that part. So let us see if we can identify Quasimodo patterns in the chart. So Mugo, you have a question?
Yes, and by the QML, you mean either an FVG or a bearish order block, right?
From there?
By a QML, you mean either an FVG or a bearish order block, right?
Yes, or even order blocks. You'll find on this zone right here, you can find the last buy candle, the last green candle before this sale. So it can also act as your POI. So basically the QML level, no, it's called a level, it's not a point. Any price above this break of structure, above this zone, any POI you find from that zone will act as your QML level. Is that okay?
So above the MS, above the
change of character.
Okay.
Right here. So it acts as your zone. So I was trying to see if I can identify a QML. Let me see. From the charts. Let me try and share my screen from this other side. Okay. Okay, perfect. Let me just do it. So, let me present from this other side. If I'm to show you something from this zone, I have a trade that I'm waiting on Solana. I'm waiting for this price to come down here. So let's see if you can identify a QML. So we have said a QML is a combination of a stop hunt and a change of character. So if I'm to come to this point right here, you'll notice, let me just zoom out like this. You'll notice that this zone was actually a stop hunt zone. A stop hunt. Here we have it, a stop hunt zone, as you can see from this part. So this is our stop hunt. Then we are having a change of character. This is supposed to be a change of character. Or anyway, as long as you understand, doesn't matter how you name them. So we are having our change of character right here. So a combination of, let me just name it for us to be okay. Let me have it like that. So if you've identified that, so I say there are two ways to trade this. So we are having this order block. We are having this last red before significant buy. So this was our bearish order block. So if I extend this like this, you notice that this was triggered from this zone. So it was actually respected and the market sold from that zone. But where will the optimal sell come from? So any POI that you find above this change of character is a good POI. And remember, you must also consider a lot of liquidities. For example, if you look at this is a lot of liquidity sitting around here because you're having a zone where sellers were most in the market. And also you're having what we call, I'll cover this maybe on Monday. This is what you call trend line liquidity right here. This is a trend line liquidity. So any POI above all your liquidities, then that will be your POI. And no wonder I took my bearish QML from this zone right here, because now we are having at the last green candle before significant sell. And that is what the last green candle before significant sell is, a bearish order block. So no wonder I'm having my take profit from that bearish order block zone right here. And if we are to look at my bullish QML, where is my entry, you'll notice we're having a stop hunt from this zone right here. Right here. Then the market broke structure from this zone. Remember, we were in a downtrend right here. Then we are suddenly on an uptrend. So this is my change of character. I don't know why I was naming this like this, but this is my change of character. My change of character, because now the market changed from now being a downtrend to now being an uptrend. So we are having my change of character from this zone. So my QML level is any price around this place, as long as I consider everything. Now you've seen, now I've highlighted my trend line liquidity like that. Then I have like a small trend line liquidity. Then from this zone now, if I'm to narrow down this bullish QML, if I'm to narrow down to lower time frames, you'll notice that I had a bullish order block from this point. And no wonder now I took that as my bullish QML. And just right now I've noticed something. The market has just formed now a break of structure from this point. So what I'll sit and wait is, if you notice, the market is coming back to fill. You remember we said all the FVGs must be filled. If you look at this place right here, we are having a really strong imbalance. And why did this imbalance actually form? Is because yesterday or the day before actually, we had this stretch right here was the CPI news. So the market bought because of the positive CPI. And remember, when we have imbalances in the market must come down to mitigate. So as the market was coming down to mitigate the CPI, it formed imbalances. And no wonder we are seeing this market now coming to fill these imbalances. And after filling those imbalances, I'm hoping that it's going to come down like this, trigger me in, then go all the way to my take profit on the bullish order block right there, like that. And also, just to confluence that, I'm noticing this also right now, just to confluence. Remember we said before taking a POI, always make sure you have confluences. If you look at this point, let me even delete this, we start vizuri. If you look at this right here, apart from this being an imbalance, this CPI stretch actually caused a stop hand. I don't know if you guys can see it. This right here was a really nice stop hand. Right here, we are having a stop hand zone. Then below it, just below it, we are having what we call a break of, right here, we are having a change of character. From an uptrend out to a downtrend, we are having a change of character. Like this, a change of character. Let me even save it. Change of character. Ian, have a question?
Yes, I thought the trend should be bigger.
What do you mean by bigger?
Like that uptrend, the bullish one, it is like a small one.
Yes, it's a small one, but still a stop hunt. Remember, stop hunt is just any place where you are stopped out of that trade. You see, even in this place, I've named it the stop hunt because this was the last swing high. So a lot of liquidity was sitting there because the traders were having stop losses at that zone. But the market came and triggered them out. That's the same thing right here. As long as, even if it's small, as long as it was the last swing high, traders will, a lot of money will be sitting there because traders will use that zone as their stop loss zone. Is that okay, Ian?
Yes, so.
So this was the stop hunt zone. This was a change of character. So we are having a bearish QM. So we have identified we are having a bearish QM. So we can have, Ian, you have a question?
And also subsequently, you see where you have like your trend line, which is a written trend line liquidity.
Yes.
You see it just there above. See, there can also be like another stop hunt because there is like a bullish trend, and then but it has been broken.
This part right here.
No. Before that.
This one.
Yeah, that part.
Yes.
Now the
iko sawa pia. That's also ni kwanza a strong one actually. Iko sawa, but also that is a stop hunt. And also you can use that stop hunt for currently with this change of character down here. It can still happen the same. See, there we are having a change of character.
Yes.
Yes, it doesn't matter. We said that the market, remember mko watu wengi in the market, what I'll spot is not what you'll spot, but the market will respect what you're seeing. Someone will come to this market, notice maybe an FVG and trade from the FVG. I'll come and notice a change of character and use that. But I was trying to show you how you can use confluences. So I've noticed there's a stop and there's a change of character. So basically, this is a QML. And you have said any POI above all the liquidities on top of this change of character can act as your POI. So if I look at this up here, what is my confluences to confirm this? I'm having a zone of imbalance right here. A zone of imbalance. So what do you expect the market to do? That now I have two confluences. The first confluence is the bearish QM. Number one. So I have on this zone right here, I know I have a bearish QM. Let me name that. I have a bearish QM like that. And also, to counter that, I know the market will... What confirms that the market is going to come to my bearish QM is that I'm having imbalances. And we said that every time there's imbalances in the market will come back to fill those imbalances. And no wonder you're seeing the market is now coming back to fill my imbalances. So what will I do? I'll place my entry, my QML zone will be just above that liquidity, so that when the market triggers that liquidity, it will trigger also my QM. So the best way to do this is have my rectangle like that. That's my bearish QM. Have 50% of that and trade that, or you can take maybe the bottom of it, depending on how you trade. You can either have the bottom of it from right there, or 50% of it from right there. Then you can sell all the way to the other bullish QM, so that the market can trigger you from this zone, then go to your bullish QM. And basically, that's the no wonder I said people in the market will see different things. This I'm just seeing now, but before you would see that ahead, I'd seen the same market can give you different things that you see, or rather different POIs, because the initial one that I had was a long position to wait for the market to come down to this, take all the trend line liquidity and my small trend line liquidity here, then go all the way to this. So depending on what you saw, your points are the same, but you saw different things. One will wait for this to come down. The bearish QM for this person is their entry, but it is the take profit for this person, and vice versa. The bullish QM for this person who is shorting is the entry for this person who is longing. So just the same thing. You can have two different points of views on the same market. Ian, you have a question?
Okay, so like on your entry, like right now, where like you have the green part it is selling, right?
Yes.
So the entry where like the profit starts, see it is at the bearish order,
QML.
right?
Yes.
Oh, I thought you'd put it on the. Oh, yeah, for sure. I actually
Okay,
said that you are going to
perfect.
aim the FVG.
Perfect. Also, the fact that you've asked that, it means now we have three. I hadn't seen that. You see why now two heads are better than one. So we have three confluences on this point. We are having, this is our QML, our bearish QML. At the same time, is the last green before significant sell. So it's still a bearish order block. Then we are having, that's the second the second confluence. Then the third one now is the FVG. And I actually think I'll let this stay so we can see how it will perform. So if it performs correctly, I'm gonna give you the results of how this trade will perform. This one right here. Because you're having three confluences, you can be wrong. We're having three FVGs, you're having a bearish QML, and you're having at the same time you're having a bearish order block. Have you seen that here? See, that's what you're saying?
Yes.
Yes.
But
So,
personally, I thought there were two. Because I thought like the bearish QML is made up of now the order block and the FVG.
No, the QML, remember I said the QML is made up of the stop hunt and the change of character. Always remember that. The stop hunt and the change of character. All those other things are confluences to it. You can add them as confluences to that.
We're going.
Okay. So basically, that's how you identify QMLs in the market. A bullish one, you've seen it from this zone right here. Let's see if we narrow down to maybe the POIs that I used to get that. So after identifying my bullish QML, basically what I did, I came back here to lower time frames to do what? To refine my entry, because my entry wasn't quite visible on the 1 hour time frame. Let me go to 1 hour time frame and show you what I'm saying. So if I come to the 1 hour time frame right here, I identified my trend line liquidity and my zone of the QML. So I know from this zone right here is where this is the QML zone. So from this zone right here is where I expect to find a POI. And this zone was so confusing because we had so many noises. You can see from this zone and this zone. So I narrowed down to like 5 minutes time frame so that I can be able to see where my POI, to refine, in short, to refine my entry. So if I come to this zone right here, now this is where I got to see vizuri, where I can get my entry from. So if I'm to zoom this zone in specific like that, let me delete all of this. What I came and found out is, now it was clear to me, there's trendline liquidity. If I look at this part right here, this whole thing right here is a trendline liquidity from this zone. Trendline liquidity. Let me name it trendline liquidity. Where is that thing? Trendline liquidity. So below my liquidity, now this is where I found a really good, what did you call this candlestick? This type of candlestick. This one right here. This one right here. That looks like Ian?
Hammer.
Yes, a hammer or a pin bar. And we said long bottom wicks. Remember, this is how you now, remember I said you have to have confluences. Now I have the first confluence was long bottom wick. You see how all those all things that you've learned this week, how they intermarry each other when you're doing your analysis. So I've found my QML zone, but I don't have an entry. But when I refine down to lower time frames, I found this hammer. And we say the psychology behind the hammer is that now this represents buying pressure, because immediately the market opened, the sellers tried to push the market down here, but they were defeated by the buyers. Remember that point? They were defeated by the buyers. So in short, this long bottom wick or this hammer pin represents high buying pressure. And no wonder now it acted as my POI for my bullish QML, because from my bullish QML I expect a buy. So this confluence that, because now it tells me there's a lot of buying pressure from that zone. So that's why I took it as my POI for my QML. Any questions? Because I think we have finished on that. Any questions? I know they feel very, very confusing, but I think if you just rewatch the videos, you'll notice they are very, very easy. Let me see if we can identify others. Maybe we can do BNB. Try lower time frames and see. And see if we can identify QMLs. Ian, you have a question?
Yes, so do you like prefer to trade with the lower time frames or the higher time frames?
Actually, I do swing trades, but I use lower time frames to refine my entries. Sijui kama hapo unanipata vizuri. To refine my entries.
Yes, sort of.
Yes, to refine. Let me just show you one here of a trade I took. I think I've shown you even this. So if you look at this, you're having a stop hunt from this zone right here. The market stopped me out from this zone. And after stopping me out, then it broke structure. So basically this zone right here is my zone of the QML. So your work is to basically, if you have identified this as a zone of QML, what else confluences that? We are having two confluences. We are having an FVG. Let me try and hide all of this. We are having an FVG. We are having our stop hunt from this zone and our break of structure from this zone. So this zone, this bottom zone here, is our red zone. Let me try and delete this. This zone here is our red zone. So we know that our QML is around this zone. But how do we get confluences and to refine our entries? Now we are having this. We are having this magnet of ours, this FVG, this imbalance, this whole imbalance, these three green candles following each other, and then in between you have a space. So that's our imbalance. And no wonder I said that it was retested twice. This first time here, you see, it was playing on the zone of the FVGs right here. But for our aim was the QML. So we know our first confluence is this FVG. So what about our entry? On that entry, when the market is coming down to fill this FVG, it will also come down on the zone of our QML, which around this zone. And the third POI is the last red before that significant buy. So you can have now your QML happening from this zone right here. Because now we have a confluence. Our QML can be from that zone. And if you extend this, you'll notice it was actually tested the first time and the second time, like that. If you notice that. So we have 3 confluences: the QML, the bullish QML, the bullish order block, the last red before significant buy, and our magnet, the FVG from that point. Is everything okay now? Any questions? Any questions? If everything is clear, please confirm for me by sending a reaction kindly. Ama mambo imechemka. Let me if everything is clear, kindly guys, confirm for me. Or any questions, or even comments, anything. Let me see if there's something you've left. I don't think there's something you've left because I've shown you how to trade the QML from the breaker blocks and from the Quasimodo level. Any questions? Ian, you have a question?
Yes, but it's not from today's class. Okay, so mine was on the DeFi. So like when you're buying anything from the Ethereum blockchain,
Yes.
can you use Base network?
From which decentralized exchange are you using? Ama you're using exchanges?
Okay, probably I'm buying something on Uniswap. See, Uniswap runs on the Ethereum blockchain, right?
Yes, yes.
So can I use Base for everything?
You can actually use Base, but I find that very, very confusing. It's better to remain on the Ethereum. I know the gas fees are so high, but it's better. Najua ni gas fees inakusumbua. Ethereum projects are very, very profitable, but the gas fees that you will pay, hey, unaweza pata ulikuwa unatumia $100 to buy a project, but the gas fees is almost half of that. And also remember, you need to transfer them if they're not in a wallet. In a wallet, you have to transfer. So also they'll charge you gas fees. So your $100 can easily end up to becoming $30. Mwende, you have a question?
Yes. I can't tell the difference between how you're identifying the stop hands and the change of character. They seem to me to be inversely proportional. So where you have the stop hand on either the upper side, you have a change of character on the lower side. So I don't know how you're telling the difference.
Okay, let me do this. Let me navigate to where we were. Which pair were we on? Let me remember. I think it was Solana. Sol USDT. Oh, let me just navigate back to that so that it can be easier. If I'm to come back to this, let me show you what I mean. I know why you're getting confused. So, for example, let me delete all of this. For example, if I come to this point right here, we were on an uptrend. This is how you get to know a stop hand. By the way, that's a very good question. We are in an uptrend right here. And we said, Mwende, what did you say an uptrend is made up of? Higher highs and? Higher highs and?
Higher lows.
Higher lows. So, we didn't expect that this market is going to come up to this point, because an uptrend is made up of higher highs and higher lows. So we expect that this low right here was supposed to be higher than this. So if it breaks through, now that becomes our stop hand. From that zone, it becomes our stop hand, because now it has disrespected what we know. This was a higher low, a higher low, a higher low. But at this point, it broke through. So it has broken through our expectations. So now this becomes a stop hand. So it has gone beyond that. Now it's a stop hand. And why does it become a stop hand and not a break of market structure? Is because a break of market, if it was let me just draw it. Let me illustrate exactly what we have right here in line form. So we have a higher low. Let me look for a space. We are having a trend like this, an uptrend of higher highs, higher low, higher highs, higher low. But what happened is this higher low, instead of becoming a higher low, it broke slightly like that, then went like this. So why we are not calling it a break of structure, not a break of, why we are calling it a stop hand from this zone, we are calling it a stop hand and not a change of character, it's because, remember we described that this cannot be a change of character. Let me just name it. It cannot become a change of character, because we said to define a change of character, we must understand that is the point at which an uptrend becomes a downtrend. But clearly from this, it did not become a downtrend. It continued being an uptrend. Like this, it continued being an uptrend and continued with its journey. So it means that this was just a market manipulation by the market makers, because they know a lot of traders will have their stop losses at this zone. Why do they have their stop losses at this zone? Is because they expect the market will do something like this. So they have their entries timing this higher high. Let me show you. They have their entries timing this higher high so that they can buy, because this is a bull market. Is an uptrend, so they are timing to buy. So where will they have their stop losses at? They'll have their stop losses at that zone right there, because they don't expect the market to go down like this. They are traders. They know that an uptrend is made up of higher highs and higher lows. But now these market makers want to trap their stop losses, so they push not that one. They'll push this like that to stop them out. It's not that because their analysis was wrong. They just want to take their money short. It's called liquidity. A lot of liquidity is sitting there. Can you imagine how many people saw that this is an uptrend, and they had their entries timing this higher low, and they take profit at this zone? A lot of people will see that. A lot. No wonder in trading we say, if you can spot something easily, know that you are the liquidity, because this is very easy. Even the basic of the basic traders know that every uptrend makes higher highs and higher lows. So almost 90% of the traders at that time, they're having their entries timing that higher low. And now their stop loss at this point. So they end up being liquidity for the market makers. They'll get stopped out, not because they are not losing because the analysis was wrong. It's just because they have been trapped, or rather there's a stop hand that has happened. So this is not a change of character, it's now a stop hand. Let me rename it. It's a stop hand like that, a stop hand from that zone. So after becoming that a stop hand, you're experiencing now a break of structure. The normal drill, a break of structure from this point. Break of structure. So that makes our pattern now a Quasimodo, and that not just a basic Quasimodo, but a bullish Quasimodo. So we expect the first sell to come from the zone of the let me minimize this. We expect the first buy to come from the zone of the breaker block, and the optimal one to come now to our zone of the QML and have an optimal buy from that zone. And that is what exactly happened on that. Where is it now? On this zone right here. You'll notice we had the exact same pattern. It was an uptrend, had a stop hand, then bought. Then the market came to test our breaker blocks right here. Remember, this is the last green before sell. That's the first way you can trade that thing. but the optimal sell, the optimal buy, because this was a bullish one, came from the zone of the QML. So even if someone took the trade from the breaker block, they are still correct. But the optimal sell, the optimal money will come from the zone of the QML, just like I've illustrated down here. Is that okay, Mwende?
Understood.
Okay. Perfect. Any other questions? The best thing is that this class is ending on a Friday, so you have the whole weekend to revisit the videos, watch them a couple of times, and also when you watch them, make sure you go to the charts and try identify that, because it is by practicing that these things become easy. I don't think you can understand these things in a week. I don't expect you guys to spot these things in a week, but with practice you'll notice even next week utakuwa unaweza kuzi-identify in the market with ease. Ian, you have a question?
Yes.
Okay.
So alafu mine is on trading view, eh? So when you're longing and when you're shorting, how does it like show your profits? Does John make up early lot size or something like that?
There's no lot size. Let me give you an example. Let's use just this. So use this. So in what? In crypto, what you do, you'll just double click on that what do you call it? Position tool, like that. Determine the capital you're using. Let's say the account size or the margin that you're using, or rather the capital. Assuming you're using $100. Assuming you're using $100. Remember, in crypto, you don't calculate things we don't calculate our profits in pips. We calculate them in percentages. So maybe you're using $100, and the risk that you can withstand on $100 is maybe 10%. So if you are risking 10%, it means if the risk in 10%, what is 10% of 100? $10. So it means once your stop loss is triggered at this point right here, then you'll be stopped out of that trade, and no wonder if you look at this, you'll see hapa kuna stop, then you have 1.5 just below here, so you can see it, the stop on the stop loss place. We have stop 1.5, 0.30, 15, then amount 90. So it means once your stop loss has been triggered, has been hit, and you're stopped out of that trade, now account yako itabaki na $90, meaning you've lost only $10 based on what you had said here. You said your risk is $10, and your risk will now determine the leverage you're going to use, because this is the only place in crypto, this is the only fields you need to fill. This part right here, account size and the risk, only those two. These other things don't matter. This is zingine za watu wa forex. So just concentrate on the account size, that is your capital. Maybe it's $100, then you're risking 10%. So if you're risking 10%, it means once your stop loss has been hit, you lose 10% of your $100. So you lose $10 like that. But when your profit is hit, then if you look at the top, hapa kuna target 6.8, 1.37, you will get the amount that will be in your account will be 145. So how much have you made, Ian?
$45.
Exactly. That's basically how you calculate it.
Now what about the ratio?
The leverage.
Yeah.
The leverage now, if you want to lose exactly what you've set on this position tool, lose $10 and win $45. Now, if you look at this bottom part here, stop. So now Apple stop. Apple stop 1.5, 0.30.
Yeah.
So this percentage yenye kwa hapa ndani 0.30. You take your risk. Remember, we risked 10%. You divide by 0.30. How much is that?
Then
10%. Remember what we risked. So we risked 10%.
Yeah, we risked 10%.
Yeah. 10% divided by the percentage loss. So now hapa kwa stop you have 1.5. Ignore the 1.5. You want the percentage loss. Percentage loss is 0.30. So divide by 0.30.
That is the risk.
So that is your leverage. That is 3x. let me give a live example of this trade that I took. We see, because I think I won like $88. This one right here, but it wasn't mine. My take profit wasn't up here. It was just here, like that. So if you come to my settings, my margin was $100, was risking 10%. So that means if my I was stopped out of this trade, I was losing $10. But if I hit my TP, I was getting 186. So 100 minus 86. 100 minus 186 minus 100.
$86.
$86. What about my leverage? It will be now 10% my risk divided by 0.35. That will be my leverage.
Like, isn't there like a way you can set it manually? Like 1:400, 1:,
what do you mean by 1:400?
Like scarving it like katsema forex 1:400 leverage, you get.
No, what I'm explaining to you is a risk management strategy to make sure you manage your risk, so that you are sleeping with peace. Unajua you're not going to lose anything. Hata if it hits your stop loss, you're just losing $10.
I get.
Yes.
When you put it like that in trading view, so you go and execute in your exchange, right?
Yes, I'll just go to my exchange, and at the futures, I'll choose my pair, which is BNB USDT. Then I'll have my buy limit. So you remember about buy limit? Buy limit. My buy limit will be at this price right here. Let's draw a line and see what is the buy limit. My entry will be at this point. That is 512.1, 512.7. Then, see, I've done all my calculation from TradingView. I'll take my stop loss at this zone right here. That is 510.9. Then I'll have my take profit from this zone, 528.3. Then on the leverage part, I'll just put, how much did you get at the leverage? 33. Then I have 33.
28. Yeah, you got 28.
Okay, I'll now put that 28, and I'll sit comfortably because I've already done my calculation. I know if it hits stop loss, I'm negative $10. If I hit my take profit, I'm positive 86. It doesn't meet. It doesn't miss this by much, because unaona hapa nilipata 86. But what I actually got for my trade was $88. So it's not by far.
Okay.
Yes.
But you're going to do that like next week. We're going to do like actual trades, right?
Yes.
Okay.
And I said it's the right time, because we're in a weekend. We can go and practice and see these things. Because from Monday now things are gonna get serious.
Zawa.
Yes.
Thank you.
Okay. Any other questions before we end this class? It's 10:35. Yeah. If no questions, then we'll end from this part. I'm sending an assignment that you guys can do over the weekend. Then we'll meet on Monday. So if no question, guys, I wish to end from that point, and see you next week. Enjoy your weekends. Bye bye.